Hello investors and traders, and welcome to the weekly market report with the market guys. I'm AJ Monty. This is a 3-year weekly candle chart of the Dow Jones Industrial Average ETF, ticker symbol DIA. And what I'd like to do this weekend is point out the effects of a prolonged upward trend and what the consequences could be once the volume starts dropping. And as you can see, we are in one of those prolonged upward trends. You can see that if I connect some of these lows from here to here to here and project out, that is more or less the upward trend line. And if you've studied technical analysis before, you'll know how to draw a channel line, which is nothing more than taking the tops and drawing the line connecting those tops parallel to the trend line. So there's your trading channel, and as you can see, we are at the upper level of that trading channel and the volume is starting to drop. As I zoom in, you'll see that we've had 4 weeks of green candles, with this week ending with a long shadow above the candle. Now that tells us that the buyers tried hard at the end of this week to push the price higher, but the sellers came in with force and we closed a little bit lower. So this is, again, the weekly candle chart. Now as I take a step back, I'd like to show you what the monthly chart looks like. This is, again, the trading channel, and you can see that I could even extend this trend line a bit to connect with what I drew here, and you could even extend that channel line as well. Just giving you a brief idea of what that looks like as a prolonged upward trend. Remember, this trend started in 2009, right after the crash of 2008. Now that in and of itself looks okay. It looks like we might just continue along in this trend. But if you look at the volume, very interestingly enough, the highs are dropping. Now, again, if you're following the market guys long enough, you'll know that price and volume work hand in hand. And when the volume is dropping as prices are going up, it tells us that the buyers are weakening. And that's a price-volume divergence, which becomes very dangerous for those who ignore the signals and continue to buy into these high levels. Now, I'm going to take it one step further so you can see some of the other things that I'm looking at. I don't just look at intraday charts, daily charts, weekly charts, or even monthly charts like this. I'll go back and look at the 100-year chart of the Dow, and you can see other signs. Now, this is a site, Microtrends, which gives you an interactive chart going back to 1913, actually, 1913, 1914. And what I'm seeing here is what concerns me the most. If you look at these tops here, you see these dramatic pullbacks after almost vertical up moves in the Dow. This is one of the most prolonged upward trends that we've had, and it's not just the time in trend, it's the steepness of the trend. And I've been talking about this for quite some time now, in that the angle of the trend can also predict the angle of the sell-off once the trend reverses. Now what we're seeing here is what's called the broadening pattern. You see the highs finding new highs and the lows finding new lows. Now this is a textbook broadening pattern, and in order to show you what that looks like, I go to Wikipedia, and if you go to this page that's posted here on Wikipedia, you can scroll down and look at what a broadening top formation looks like. And this is, again, textbook here. We have point A, which is a high, point B, which is a low, point C, high, point D, a lower low, point E, a higher high. And in a candle pattern, you can see as I circle that with my cursor, that's what it would look like on a technical chart when you're drawing the lines out. Now what I'm going to do here for you is I'm going to superimpose that pattern that we see here onto the actual chart of the 100-year Dow Jones Industrial Average line chart. And as you can see, as I bring this in, here's point A. Well, where's point A on the chart here? Right there. Here's point C. Here's point E and the lower lows, respectively. A, B, C, D, E, A, B, C, D, E. Now, if you're ignoring this, then I don't know what else I could do for you, because you're missing out on opportunity if you do not start to take action and really pay attention to the signals. Because remember, the last thing I want to see anyone doing is just holding on to their long positions when the market starts to correct and goes lower. You see, this is the broadening top. Again, I'll remove the lines here so you can see, and I'll draw that out for you. Point A here, point B here, point C, point D, point E. So in a broadening top, what would that look like? It would look like this with a lower low. So this doesn't look like much on this particular chart because it's a 20-year monthly chart. But if you look at the price and you look at what this could mean, if in fact this broadening top does follow through and we come to a lower low, we're talking about Dow 6,000. That's a 12,000 point drop in the Dow. Is that going to happen overnight? Of course not. It's not. Remember, this is a monthly chart. It could take a few years. It could take 5 years for us to get back down to Dow 6,000. So there's no need to panic here. But this chart right here, if I go back to the weekly chart, you can see it'll give us enough time to prepare. You see, look at the steepness when I go to the weakness chart compared to the monthly chart. Big difference, right? Because we're looking at 20 years here, and from 2015, this could be 2020 out this way. Then you switch that to a weekly chart, you can see that we do have time to take action. So if this high that we see here ending in the month of February, that we see this more or less spinning top on lower volume, that tells us watch out below. So again, plenty of time to prepare. There's no need to panic. But what I'm trying to do is get people out of this buy and hold mode. It's now hold and protect. That's what the strategy is shifted to. You can hold your positions as it goes up, but make sure you're protecting those positions for a move lower. If you look at the Russell 2000, this is a more broad-based index. You can see the broadening patterns are forming here as well. We have A, B, C, D, E came down a little bit, but we're forming another top. And this whole top here is a broadening top right here. See how that looks? That's, if you go to any technical analysis book, you'll see broadening top formations. What this tells us is that volatility is increasing. And when the volatility starts to increase, then what does that mean? If you look at the volatility index, and you have to understand that volatility works inversely to price. As volatility increases, there's a very close relationship to those down markets. So we could easily see the Russell 2000 dropping to a low following this broadening pattern that we see right here, which could mean the Russell 2000 dropping to around 1,000. Let's take a look at the spiders, SPY. This is S&P 500, and you can see here on the trend lines, if I drew from this low to this low, projected out, again, another trading channel, textbook all the way, trading channel. We have, as I zoom in on the weekly chart, you'll see that we have an inverted hammer. That's a bearish sign. You have a long shadow up on top, very narrow-bodied candle right there. That is bearish, so we could easily see. Now remember, this is a weekly chart, so I'll leave this up here. We could easily see the prices drop on the S&P 500 as well. Looking at the Qs, QQQ, you'll see that it's, again, just like the other markets that we've looked at. We have a trend line, we have a channel line that we can draw parallel to that. Textbook, we're up at the higher levels of the channel with, once again, you have a doji here on the Qs, which could very well mean a pivot point, because when you see dojis, usually dojis and spinning tops like you see down here are usually signs of pivot points. We see it very close to a doji here, spinning tops. So we have to be very, very mindful of the fact that volume is dropping on the way up. and we want to be very defensive in keeping our stops in place for any long positions that we have. Now, the other good news is really for the option traders. If you're an option trader, then you have ways to make money both on the upside and the downside. And while markets are trending, channeling, or even moving sideways in more or less consolidation patterns, you can make money. So if you're not an option trader, make sure you go to the Market Guys, look at some of the videos, send us an email if you want to learn more about options, and we'll guide you along the way to steer you in the right direction. But remember, this is not a time to be overly confident that the bull market is going to continue. What I showed you in the Dow Jones Industrial Average, especially in that DIA chart, going back to the monthly chart, this, folks, is a bubble. This is what bubbles are all about. We had the bubble back here right up into 2008. We had another bubble up into 2000. Back in those days, we all heard the news. We heard the analysts talk about bubbles. This is one of the biggest bubbles I've seen in my 30-year career, and I'm just doing my best to prepare everyone so that you'll be able to make money on the way down as well. Believe me, you make money faster on the way down as long as you're positioned correctly, because fear takes over and prices drop more quickly than they go up. So that's our weekly market report. Thank you for joining us. Remember, Monday we're having a makeup session for the open house Q&A. We had technical challenges last week. We're having the makeup session at 8 p.m. on Monday. Registration link can be found on the front page of the Market Guys website. So stay tuned to that, and I look forward to speaking with you at 8 p.m. on Monday. Have a great weekend, folks. So long.